Welcome to the Marketecture podcast. This is episode 10, I think. We have, as usual, I'm Eric Caparo. We have Eric Franchi, and our special guest today is Brian Wieser from Madison and Wall. Brian, thanks for being here.
Actually, it's Brian Wieser, but I'm very happy to be here.
I'm a terrible host. Before we get started,
fantastic host.
Brian is going to have some really exciting things to talk about. Before we get started, let me just do a little PSA. This podcast is getting very popular in the advertising world. If you could, leave us a 5-star review on Apple or Spotify and help us grow the audience so that more people can hear this. Someone described this podcast to me as like the Professor G podcast, but not wrong about everything. I thought that was pretty accurate.
Thank you, whoever that is.
You can't get better than that. Brian, you've been around for a long time doing in-depth analysis of the advertising world with sort of a financial bent. Now you're off starting your new thing. So tell us about it.
Yeah, well, first of all, thanks for having me here. I love the podcast. It's one of the only ones I listen to regularly. So, yeah, no, I'm, as some of you may be aware, former agency person, former investment banker and analyst, and now I'm doing independent consulting. You could call it fractional employment by other means, but basically Madison and Wall is a consultancy, and it's me right now, publishing research, which is really just me organizing my thoughts and giving you something that's more accurate than something that Professor G says.
Right. Well, it's more than just publishing some research. You go pretty in depth with the financial bent. Is the basis of the consulting and the writing intended to be for investors, or is it also operational?
No, I mean, actually, operational is probably the primary stakeholder set that I'm focusing on. You know, I obviously understand how investors think more on the public market side than the private side, but to the extent that I am a CFA charter holder and I've always had a financial bent to how I've looked at the world, what I do is that I can help explain to a company, an operator, how investors think or are willing to think if only the operator can persuade them.
Right.
But that's actually, it's really, really interesting how afraid companies are of their investors, I think.
Why is that?
I think that they've been trained to believe that investors are focused on the quarter. They interact with investors who don't know their industry and think, oh my gosh, these are the people with the money I have to persuade. You know, it's intimidating to people who haven't come from that world. Sometimes what I observe is that executives are maybe as afraid of their boards, who are in turn afraid of investors. And I think that a lot of this comes from a lack of understanding that investors don't want to have to focus on a quarter. Investors don't want to have to focus on the short term. They want to be long term, but they're not typically given good reason to be focused on the long term.
So post acquisition of Undertone by Perion, I spent a good amount of time in a quasi investor relations role. And it was pretty fascinating. And I think this might be somewhat of a ad tech centric thing, but to your point, Brian, the number one issue was just investor education. So if the investor got it, then they could be more focused on the long term and differentiation and secular trends. But if it's like potentially a new investor or one you're sort of like pitching on the stock, it becomes challenging because I think there's still a steep learning curve with respect to how these businesses operate, how they make money, the sustainability versus Google, Facebook, Amazon. I think the education piece is pretty tough. And that's why, that's why it's hard, because you just need to spend a lot of time doing it. And, amongst everything else you have to do as a public company CEO.
For sure. Well, and I'm just going back to then what I'm trying to do. And I've already had one engagement where I've worked on this, where I think I can help companies both refine what their strategy is, help them figure out what their superpower is, and refine where the opportunities are, because I am the creator of two of the industry's three main data sets that people rely on for, the health and future trajectory of the advertising industry. So I'll claim to know a thing or two about that and how to think about TAMs and, assumptions that are embedded inside those assumptions. And so basically helping companies figure out where their opportunities are and balancing that against what the investor story is, whether for public or private, I think is probably a sweet spot. But I think that there are other, conversations I'm having with companies that are maybe a bit more operational in terms of figuring out opportunities for those companies to grow.
So can you name check the two data sets that you mentioned?
Oh, so I worked for Magna Global, which is part of Interpublic. And I basically blew up the data set that basically everyone had been using for decades, completely recast it, and helped bring aboard a successor, Magna, and Vince Letang is amazing, has done great work. It's his data set at this point, but the historical data, I set the framework that I think is still in place there.
And that's for global advertising spend.
Yeah, global advertising, exactly. And that was back in 2010, 11, I left. And then I was at Group M, and so did WPP from 2019 until January, and basically did the same thing. And so that data set for global advertising has basically the same framework and same logical underpinnings.
Yeah, I want to get to global advertising projections in 1 second. But back to investors being scared of ad tech or not understanding ad tech, it feels like the perception of ad tech goes through this sort of peak and valley on Wall Street. You have kind of the rocket fuel era, and then the crash, and then you have the Magnite worth $10 billion era, and now we're back at a crash. Is there something special about ad tech that makes Wall Street a little schizo in the subject?
Well, I mean, here's the thing. Back in the rocket fuel era, investors didn't know how to spell DSP. Like, it was just one of those things where I still remember the within a week, Rocket Fuel and Criteo went public, right? And I wasn't covering either of them. They were too small for me to focus on given what I was doing. But it was like, okay, this is like a ludicrous situation. Rocket Fuel and Criteo are fundamentally different in terms of what they should be valued at, yet they're valued at the same value. And what I observed was a month later, Alibaba went public. Remember Alibaba, right? Slightly bigger company.
Yeah.
What I saw from my clients in terms of the time and effort they put into Alibaba, and it was light years of difference. And this is a really important story that I don't think enough people appreciate. The largest investors typically cannot or will not buy more than 1% of a given public company.
Okay.
Right? It's just, there's all sorts of reasons why they don't want to. 5% becomes like a legal threshold in many cases, but 1% is like a lot to own of one company. Okay. If you're worth $1 billion, what's your investment? 10 million, right?
Right.
Imagine a company's worth $100 billion. What kind of investment are you maxed out at? $1 billion.
Yeah.
Billion.
How much work would you put into a $10 million investment versus $1 billion investment?
I guess it's dependent on AUL, but obviously, for any large firm, it ends up being the larger.
Yeah, and that's kind of the bigger problem. So in the earlier days of ad tech, certainly, there just wasn't a lot of effort put into it, either by the sell side or the buy side. I at least had come from, I worked for Simul Media for a year, and obviously at Interpublic, I spent a bunch of time in sort of the early, pre-programmatic ad tech, understanding how a lot of that worked. When it came to some of what we saw like last year, where you had some really frothy valuations, I think that was just, when capital costs zero, you can see some pretty crazy things.
Right. Right. So this is a combination of relatively small market cap with really complicated businesses.
Yeah.
And at some point, people either say, and maybe I'm putting words in your mouth, people either say, YOLO, let's invest, or they do the opposite, like, this isn't working, let's get my money back.
That's a fair way to characterize it, and at least for the shorter term investors. And there are many. I mean, to be clear, a lot of investors are focused on the short term by trading volume, but not by assets under management. That's a critical distinction.
So, right now there's a lot of public market ad tech companies whose valuations are just awful. I was just looking up, not to pick on people, there's like AdTheorent and Acuity Ads, a bunch of $100 million valuation companies where they would probably have much higher valuations in the private market. Really the only company that's doing extremely well other than Trade Desk is Perion. Yeah, and that only went up since you left, Eric, more or less, right?
Straight line up and to the right.
But Brian, actually, I was hoping you could comment on the low market cap companies. Are these folks dead in the water, or do they go back up when and if the markets recover some footing?
Yeah, well, I'm not formally covering stocks right now, so it's hard for me to opine on the specific valuations. But just some general observations, looking at the businesses, I don't know. I think that there's definitely still some froth in how investors look at some names. Take the Trade Desk. You could look at it through the lens of investors are assuming that they can grow into their valuation.
Right, for the Trade Desk, right?
Yeah, there's no other way to justify a valuation that the Trade Desk is at, unless you just have a view that they're going to figure it out. And that's okay. You could be optimistic. I think when it comes to other companies, it's really hard to say what the right value is for a given company. I think that the small ones are definitely in a difficult position because they won't get the attention that they probably deserve. This is generally true for any smaller company. If you've only got a market cap, even revenue base, it's in the low hundreds of millions of dollars, it's really, really unlikely that you're going to get the attention you deserve if you've got a good business. The only answer is scale, frankly, or go private.
Right. So if they could drive performance many quarters in a row, start showing increasing earnings, increasing revenue, maybe you get someone's attention.
You might get attention, but I mean, if a business had, say, $100 million of revenue and grew at, say, the rate that the trade desk is growing, you still wouldn't necessarily get the kind of multiples that the trade desk has because you need a good story for starters. It needs to be a credible story. And then you need attention. And even with attention, that kind of size, you're not really playing in the big leagues unless you've got a much bigger business.
And Eric, what's the impact of this environment on private investment? I imagine many entrepreneurs want to be compared to the trade desk, but you could also compare them to one of these, 1x revenue companies.
Because the class of 2021 in terms of the number of IPOs and valuations was, somewhat of a moment. I think that the early stage companies, on average, never really sort of saw the benefit of that in terms of their valuations going up, because I think there's still somewhat of a investor education issue on the generalist venture side. And then conversely, I don't think we've seen valuations necessarily go down all that much, just based on the public market comps. There's not too many Series C and Series D rounds going on right now in ad tech generally, and those that are sort of kind of being led by insiders who have the benefit of sort of supporting the companies and having inside knowledge. So I think if we saw more C's and D's, we'd probably see a similar valuation compression happening, but we're just not seeing it right now.
Right. Something else to keep in mind when it comes to valuation, it's often hard to say are stocks undervalued now versus were they overvalued before. What really matters in my experience, and this is just going to be true whether you're public or private, is you've got to have a basic framework for why you think a given dollar of growth is worth a certain amount of capital, right? Whatever that view is, form that view, have that view. Don't assume the market is right. The market's doing what the market's doing based on short-term gyrations. The smart thing to do is identify when things are out of whack based on your model for the future. And what that means is if you think that you can't possibly justify your valuation, that's when you raise capital. Because implicitly, the market is saying, we don't know how you're going to do this, but we're going to trust that you can grow into this valuation, like the trade desk did. Mm-hmm. It has been overvalued in that sense. Roku is a really interesting company to point to, where I think again, I wasn't valuing the company, but I think a lot of people were pointing out kind of the obvious, how is this company worth this much money? And then you remember they announced a really small deal with Nielsen, and the stock popped was worth another $3 billion for what must have been a tens of millions of dollar revenue transaction. And what did they do the next day? They raised $1 billion of capital. That's the right way to play it. The opposite way is to say, okay, well, if in fact we're undervalued and everyone else is undervalued, you should be buying the assets, right? And basically, if you have that conviction about what the right way is to think about what a dollar of revenue or dollar of profit is worth from a capital perspective, and you see the market is just undervaluing it for a bunch of reasons, you should be rolling up different assets.
That's such a good point. And that's saying another way what I was sort of saying in terms of, companies that are at that B, C, D or later stage that we're seeing funding happen within. It's happening from insiders who have strong conviction, have probably more knowledge, more histories with the company, and they're rolling their sleeves up.
And certainly if valuations are low, you don't want to raise money unless you have to. So you want to keep going. You want to, even if you're running on fumes, just keep it going, get some profitability, wait it out a year or two.
Sure. Unless there's a gap, again, between what it costs you to raise capital and what you think companies are worth, in which case it is worth raising capital. There's a ton of dry powder out there. That's the thing. If you basically think that you can raise capital and it's only going to cost you the equivalent of, I don't know, 10% or something in terms of what your cost of capital is. And yet you think that assets are undervalued by, I don't know, half of what you think they're worth based on your framework for what drives value. You should be buying assets all day long. Raise capital, and even if it means diluting.
Right.
And buy assets.
So let's talk macro. So macro from the advertising perspective, you're probably most profound thinker on this subject, and I'm really confused. So I thought we were in a recession, which would mean advertising would be declining because advertising is very secular, and yet and yet advertising is growing. I think the number you put in your last newsletter was 6%. And then to make things more complicated, the ad tech companies are growing faster than the advertising world at 12%, and the holding companies are growing faster. So what does this all mean? Can you make sense out of this for me?
Yeah, and so what you were saying is a common view, meaning a lot of people think that we have been in a recession, or we are in one, or we're about to go in one, at least people in the industry. And so a couple of facts, and I point this out on my recent Substack newsletter, Madison and Wall. So a few things. First, we have not gone into recession in the United States. There are some countries around the world which have, but the United States has not. You could argue that maybe the first half of last year was a recession, but it's only because of a weird quirk in exports, which would really not have anything to do with advertising. And it was, again, a quirk. And it was the first half of last year when things were really, really healthy for advertising anyways. I think that the industry talked itself into a downturn because people believed, conflated even, that high inflation would lead to high interest rates, would lead to stagflation, high interest, and weak economic growth. And there was just this assumption that it would be like the 1970s. It just kind of ignored that consumers are sitting on tons of cash, let alone institutions are sitting on tons of cash. The money's going to be spent. It's just a weird, weird world. And so sure enough, what we see, if you look at the data from last year, in real terms, meaning inflation adjusted, the economy was kind of normal-ish, right? It didn't feel normal, but it sure was normal when you look at the numbers. And the critical thing is that most people don't understand is that inflation in a normal-ish economy or a positive economy is additive to advertising because most companies budget for advertising on a percentage of revenue basis. So if you have higher inflation, it means you pass costs along to consumers. It means your budget for advertising goes up. And sure enough, that is kind of what we saw last year. Fourth quarter, we definitely saw a deceleration for paid media advertising. Fourth quarter was certainly weak, but it was still positive. But then digital advertising, stronger, mid-single digit probably. And then this is the critical thing. Ad tech, along with agencies, were really strong. And that's
why is that? Are they taking more of every dollar?
Well, again, we can theorize what's going on, right? Because this is contrary to the common narrative. The data tells us that this is what happened. So why could it have been the case when marketers around the world have been talking about cutting their spending on so-called non-working spend? Apparently, all those years I spent in agencies, I wasn't working and no one else is. Apparently, you guys in ad tech, oh yeah, you're not working either.
No, we don't.
Unless you're selling media. So Eric, I guess you actually were working, and Ari, I don't know, did Beeswax sell media? I don't think so.
We were definitely non-working.
Yeah, you didn't work. Okay, good. So this notion of working and non-working spending is, it's kind of insulting in some respects, but whatever, it is what it is. So it's clear that the non-working spend was growing faster than the working spend. We can hypothesize the reasons for this. If you spend more money on data and tech and services, you can make the rest of your spending way more efficient. That's the most plausible explanation I have.
So you think this is just an accounting issue, that you're moving from working to non-working? And for those of you who aren't familiar, working would be the media dollars, non-working would be sort of overhead, including tech and data and things like that.
Not an accounting issue. I mean, by that, it's to say, I, a marketer, have $100 million to spend on advertising this quarter. I normally spend, let's say, $90 million with media owners and $10 million between agencies, data, and tech service fees. Could you possibly cut the spend on the media from 90 to say 85 million, spend $5 more million on services, on data and tech, and drive better results, whatever your KPIs are.
Right. So you're saying this is an efficiency play that, or
we can theorize that's a possibility.
Yeah. But what's going on with the holding companies? I'm not by any means an expert on the holding companies, but they've done tons of acquisitions. They're in the data business. Is that a really important factor in this whole kind of strange world we're in?
I wrote over a decade ago that, and I think you guys talked about this, I think in context of Media Math and the bet that they made and others that the Trade Desk didn't make, this idea that there'd be a lot of in-housing, right? I was clearly on the other side of that argument, saying that no, it's not really going to happen, not in a major way. So what happened was, I wrote this in my initiation, like 2011 or 12 of the sector, that for agencies, it's good to get paid by the hour in a world where digital is increasingly important, because
it's harder.
It's way harder.
Yeah.
Way more labor intensive. And that means to actually execute on all these digital fantasies, for lack of a better word, or digital ideas, whatever you want to do, you need more labor. And sure, the more tech you get, and again, I've only spent a year working in ad tech, but from what I understand about how you can have a great idea, but you still need people to patch it all together, especially the more complex a campaign is. So agencies have always had that as a positive thing. Through the latter part of the 2010s, they did have a few issues at play. Primarily, it was the creative agencies which have had a problem. Marketers, again, not always making the wisest choices. We can argue that nothing will drive better performance in a media campaign than good creative.
True.
And yet, marketers have been cutting their spending on creative consistently. That hurt all the traditional creative agencies. And that was probably the biggest single drag on what we saw between 2016 and 2020. And we can talk about a bunch of other factors, again, were rebates an issue or not an issue and all that. But the biggest single issue was cuts in spending on creative. And I think that's kind of normalized at an industry level. So that's the first thing. The digital spending means more services broadly. And that's probably been the best single factor driving the health of the agencies the last little bit.
I think creative has been in-house to some extent, not the big creative, but the day-to-day. There's companies like Oliver that do in-housing of creative.
A lot of it has. To be clear, there's a lot of good stuff, but it always was.
And what about ATT? So ATT hit Facebook and several other, I'm talking about Apple, ATT, hit Facebook and several others pretty hard, brought their revenue growth to a standstill maybe. YouTube's not growing. I don't know if that's a factor. Like, is that something that is a sea change that we should be looking out for? Or is it just another detail in this big, messy situation?
Yeah, I would argue it's mostly just a detail. I in my former podcast, This Week, Next Week, which no longer is being made, early on we referenced comments that Facebook was making about, how they're being hurt by AT&T. And then they're being hurt by TikTok. And I did liken it to, Erwin Mainway, remember the bag of glass, and just, trying to distract everyone from what was really going on. It was a convenient thing to point to as a problem for anyone who was underperforming for one reason or another. I don't doubt for a minute that there was a modest, like single digit kind of impact for some companies like Facebook. Right. I don't doubt that there are some marketers who would have found that their ability to target were impacted and that their overall efficiency was impacted. But when you think about how most marketers manage their advertising budgets, the use of data just helps improve where the spending goes or changes where the spending goes, but the budgets are typically set independently. That's not true for every D2C brand out there, but that's not necessarily driving the industry.
Yeah. I think the best estimates I've seen is from Eric Seufert, who's a contributor to Marketecture, on his excellent blog, Mobile Dev Memo. And I think he puts the impact on Facebook at somewhere between 7 and 9% of revenue.
I don't agree with that at all. I think it was a low single digit impact.
Love to have a cage match to have you both on.
No, the reality is that when you think about segments, different segments of marketers. So let's talk about large brands and small businesses.
Okay.
Typical small business in the United States has about $1 million of revenue, about $10,000 of an advertising budget, 2.5 employees. Okay. Think about how they're managing their advertising budget. Do you think that the ATT changes had any impact whatsoever on how that business, $800 of spending per month, how they allocate their resources?
No, absolutely not. But they may have been unable to fulfill the exact same budget they filled on Facebook and Meta the previous month. And if you have millions of people whose budgets are being cut by a couple percent, and
Yeah, a couple
big
percent.
advertisers who maybe a bit more.
Large advertisers, I disagree. I don't think any of them made any meaningful changes because of it.
I'm not an expert in this area, so let's let's call it a mystery. I have one last question, which is if you buy a media buyer like a really expensive pair of denim jeans, is that working or non-working capital?
I thought that kind of got rooted out after all those articles in the mid-2010s.
Eric, what do you think?
That's not. It is not working media. It is classified as T&E.
No, when you were in the game, when you were at an ad network, you had to approve some of those expense reports, didn't you?
Yes.
What was the worst thing you saw?
I've heard of, very extravagant dinners. I've heard of jeans parties.
Jeans parties.
How about the apple picking parties? I loved reading about those.
I've not seen that.
Is that Apple devices? I
Yeah.
imagine. Not Apple fruit.
Again, these are just things I've read about because I wasn't.
Yeah, these are things that I've read about. Nothing I've been a party to. You know, I've heard of excursions to the Hamptons. So yeah, there's no shortage of T&E that historically has been part of this whole thing.
Definitely a lot more sexier than venture capital.
Yeah, so I've heard.
All right, let's talk about the news of the week. It started out as a slow week, and then I started adding things to our little digest of things to talk about.
Yes, but it was not a slow week because there was a very important company launch this week. So there's this classic question that folks in advertising like to ask, which is what's the last ad you remember? Right? It's a head scratcher. Sometimes there's a canonical TV ad, maybe from the 80s or something like that folks tend to point to. I would argue you could probably ask the same question around product launches. Maybe a little bit less sexy, maybe a little bit more sort of like B2B, perhaps B2C. But if I say, what's the last product launch you remember, likely it's going to be Steve Jobs standing on stage with an iPhone. So about 18 months or so, a smart, experienced entrepreneur came to us and said, hey, I think that there's an opportunity here to actually build a product, but a platform to help systematize and improve product launches. Because in my experience, product launches are either, number one, horrible, and they just get rolled out and nobody sees them, or on the other side, they're backbreaking. And because there's no process and who owns what and everything like that. So I was very pleased to see that company launch this week. And it's called Launch Science. My fund is an investor, and Ari is the founder. Tell us about it.
Wow, you really laid it on thick over there. I appreciate the you doing my bidding for me. Yes, Launch Science came into beta this week. You should go to launchscience.com, sign up for the waiting list. It's a platform for helping companies to launch and commercialize new products. And it's a real problem. I've spoken to tens, maybe 50 total folks who are in charge of commercializing new products, and they have a real problem doing it. It does beg the question about whether this podcast is my side hustle or that's my side hustle. I guess we'll have to wait to see which one gets bigger faster. But yeah, I'm very excited about it, and I appreciate Eric you bringing it up as well as being an investor. So let's get back to ad tech though, because that is not ad tech. So a lot of interesting news this week. One thing I just saw yesterday was that the Walmart CFO said they're going to make more profit from ads than from selling stuff in a couple of years. Now, I've heard this before from other companies, but Walmart...
Including Amazon.
Walmart's pretty big. They've got a lot of stores. I guess the key word in that sentence is profit, not revenue. Brian, what's your take on that?
Yeah, I think that when we think about where they're focusing, I mean, obviously the advertising angle is what we're thinking about Walmart Connect and otherwise. There's huge opportunity for them. I mean, clearly Amazon's leading the way in terms of what's possible for retailers to generate revenue from advertising. Now, I'm not an expert on retail. I wouldn't claim to be one. I don't know that. We know that they've tried to move into financial services, and different retailers have done the same. There are plenty of other services that retailers can be a hub of. I don't know Walmart's story well enough to know to what degree they're counting on Connect versus other services, though.
Yeah, it's every time Walmart talks about the ad business on the senior level, right, CEO and CFO, it's almost like they express wonder at this like business. It's like, where have you been all my life? And I right, and I think the profit thing is key, right? And in that article, it's a Reuters article, we can put it in the show notes. Basically the expectation is that advertising related profit margins are 75 to 80%, and then overall core margins for Walmart is 24%. So obviously, if you've got a fast growing advertising business, you've got plenty of room to grow, and companies like Amazon and Google in your sites, you feel like there's a real path there. But I think it's no surprise that they're just basically taking, a lot of the narrative that Amazon has been championing, and if they're competing directly with them in every way, the advertising is going to be no exception.
I think it's interesting. I was also listening to Vizio's most recent earnings investor calls as well, and they can make a similar claim in the sense that all of their data and advertising products are such high margin businesses compared to the core legacy, if you will, TV consumer electronics manufacturing business. So I think that wherever you see opportunities to apply advertising as a service, I mean, when it can be such a high contribution margin activity, it's a no-brainer to try. Whether or not they actually make all the continuous investments that are needed will always be another story.
I was just going to say, Walmart has been in the retail media business for over 10 years. They had a very deep relationship with Triad Media, which was acquired by WPP, sort of in the pre-programmatic era. It was very much about sponsorships, and you take over the page that was about Father's Day with your golf club ads and stuff like that, but it was very lucrative. And then they ended that relationship and sort of in-housed it all and went quiet for a couple of years, and now they're just back in full force. Eric, you were going to say something?
No, I just said a comment. Brian, you use a term like applying advertising or applied advertising. I think that's a really good term. And there's like people talking about everything is an ad network. Hat tip to Eric S. or first party data networks. I think this concept of applied advertising is important, right? Because it's not one size fits all. Retailers versus non-retailers, so on and so forth. And applying advertising to your model might not be the be all end all, but can certainly be, a great growth vector, a great way to experiment, have more from a user experience perspective, and obviously, tap into some of the media plus data revenue and margins that are extremely attractive.
Yeah, well, like Uber is another good example, right? Where, I mean,
we love talking about that one.
Yeah, exactly. And I think for the, food delivery makes perfect sense. Now, can they make it meaningful? I don't think they've made disclosures about it to, what share of the revenue comes from, in-car experiences. I was just in one yesterday where the driver had some sort of screen, and it sounds like it was provided by the company. I don't follow Uber or Lyft very closely.
But no. At this point, actually, a former investment of ours is the leader in that. It's called Octopus Interactive. It's owned by T-Mobile. Uber and Lyft, it's somewhat controversial about putting things inside the cars because Uber and Lyft drivers are contractors. They're 1099s. They're not employees. They can't say, hey, you got to put our screen in the back there. Then it becomes a little bit of a battle of, who's got the best offering for the drivers, which I think is a good thing.
And there's also top of car where,
that's where Uber, I think, is going to,
it's different by local regulation. Some places it's a monopoly. So, like in New York, there's a single deal for all the taxi tops, and Uber is participating in that, but not running it. So it's pretty interesting, complex business there. While we're on retail media, another minor deal that a lot of people might have missed, which is Criteo did an acquisition of a company called Brand Crush. I don't know very much about this company. It's a shopper media company. But what I think is interesting is they do a lot of offline shopper media. So they will do on-premises things like pop-ups and product sampling. And they do in-box. So advertisers can put their samples in the boxes that are being delivered in a logistical form. Kind of makes me intrigued. I don't know very much about this. Did either of you catch your eyes on this?
I did. And I think that the way you're thinking about it is the right way. Sampling, product distribution, codes, that's just a way to capture more first party data, right? So if you start to think about that in the context of Criteo's core business, their ambition to be more and more of a player in all things retail, and then have additional touch points they can use to tell a story about closed loop attribution. It makes perfect sense.
Yeah, there's also a long tail of advertisers in retail media because retailers often have a lot of SKUs, and you may have a problem where digital's not big enough, and you want to give them a package that includes a lot of other things. So that might be an exciting thing on the advertiser side.
Yeah, the other thing is keep in mind the broader relationship that if you're a Criteo or anyone pushing in retail media, technology is trying to pursue, right? So versus Citrus Ad versus Promote IQ inside of Microsoft, that you want to make sure that if a retailer is going to pick you as their primary partner, is there something else that you're adding?
Right, exactly. Other news. So Jeff Green from the Trade Desk, he's the only person we talk about almost as much as Elon on this podcast. So he's on the warpath against Google. He's been posting to LinkedIn. He wrote an op-ed on The Current. So a side note, little public service announcement. There's a website called thecurrent.com. It's cool. It writes about Google and how evil they are. That's really just a blog that's owned by the Trade Desk. It's not a real publication. It's a internal publication. So nothing wrong with that, but let's just be clear, it's not a journalistic outlet. So he writes that, looking at Google antitrust is only the start. It's the biggest behemoth holding back innovation everywhere. And then, OpenPath is nothing to worry about. And they're the good guys, if I could summarize his various posts this week. I guess, Brian, you've been talking about the Trade Desk a bit. Like, is this rational, the way they're using PR to try to make their points against Google?
I mean, it's as good a time as any if you're them, right? No, I think that, the battle for them could be fought either in the U.S. or Europe or both. And obviously they're much bigger in the U.S. and, it's just easier, if you will, to get a message out or reinforce a message that maybe, a Wall Street Journal or New York Times or Washington Post picks up and amplify the points that they've been making.
If DoubleClick were forced to spin out its sell side. So as a reminder, the Department of Justice has not asked Google to enforce any remedy against DV360. The remedies in the DOJ case are entirely on the sell side to spin out AdX and GAM. How would that help the Trade Desk vis-a-vis competition with DV360? That's kind of a hard question, but
I've heard what you guys were saying, and there was a fantastic oral history, by the way, the other episode. But I think that at some point over the next few years, I'm still of the view that Google will decide that they should self-deport essentially their large chunks of their ad tech business, and it may or may not be the parts that the DOJ is asking for or suggesting that they might want. If they just determine their own fate by taking some kind of action that kind of preempts the whole premise of the case and makes big tech a little bit less big. We don't know what shape it would take, but I do think that something like that will happen.
And whatever happens, probably good for the Trade Desk.
Well, you could argue the opposite in the sense that I think, and maybe tell me if you disagree, I think that Google's ad tech business has to be operating with two hands tied behind its back right now. They can't take actions in the same way that the Trade Desk does. They cannot possibly be as aggressive as they would want to be on a lot of fronts. And you have to further assume that back to how capital gets allocated in large companies, if you're that part of the business and you're trying to compete with, let's say, Google Cloud for resources, who wins in that argument today? Right. Google Cloud. If they're a separate independent company, they could raise capital all day long if they needed it, and they could invest in whatever direction they want to and would be far less restrained. Is it really good for the Trade Desk if they're out there? It might be just better for everyone, for the whole sector, frankly.
I could talk about this for hours, but, off the top of my head, if DV360 was spun out, let's just say, they would lose access to YouTube, which is the number one reason to use the product, but they would be very unconstrained around use of data in ways that they are now. Like, for example, it's pretty well known that DV360, other than YouTube, is a real laggard in connected TV. And the reason is because in connected TV, people need to use data in ways that don't kind of meet Google's privacy standards. So I could see both those things having big effects.
But I wonder if the access to YouTube is really the most important thing strategically. I'm not saying it's unimportant, but I think that the thing that's most important that I've observed about DV360 is the fact that everybody knows how to use it.
Really? Because the usability is there, but I would say after YouTube access, you would have things like combination with DCM, combination with Ads Data Hub as being kind of the killer feature.
But YouTube by itself, I'm just saying, I don't know that I'm not saying access to YouTube doesn't help them, but I don't know that it would make, I mean, obviously we don't know any actual data because there is none. I don't know that it's the driver of its market position.
Yeah, I definitely think they get accounts they wouldn't get otherwise, but I don't know if it's the driver, and we have no idea, really. So last bit of news, this is pretty minor but interesting to point out, is that YouTube is sunsetting their banner overlay. So when you're watching YouTube, obviously you see a lot of the pre-rolls or mid-rolls or longer form content, but every once in a while you see a little banner ad or a text ad that shows up over the video. And that was actually their first format. So when YouTube first monetized, it was all the overlays. And I guess 10 years later, they've realized they're not the most effective ad units. Maybe they're annoying, and they're going away. Is this the end of an era? Eric, I think you were kind of worked up about this.
I was now worked up. But yeah, it has to be the end of an era. How rare is it for an ad format to be sunsetted? It's very, it's the opposite of lunch signs, right? It's like sunset signs. So I think that's interesting. I think to your point, the fact that it was the original shows how much evolution there's been. But the thing that I thought about was this PMax product that a lot of people are all up in arms are. So 15 years ago or so, after AOL bought advertising.com like cleaned house within AOL because they got access to all of the AOL ad formats. So this is like the 120 by 60 on AOL Instant Messenger that was persistent and refreshed and dropped cookie after cookie and so banners everywhere, all that stuff, right? So basically, advertising.com would, take deals on a CPA, experiment across all of the different portfolio formats across AOL, and then just drive performance. PMax is the modern day version of that, I think, with a little bit more transparency. So it surprised me that they would sunset a product, because that means that, like, literally nobody's seeing value out of this. People just like click it off out of habit. So I thought it was interesting. The fact that they're sunsetting this product, sunsetting the first product, having a performance-based ad off, it just means the thing was like completely horrible and not even worth running.
Yeah, it's a good way to put it, because PMax, otherwise known as Performance Max, is Google's program where it's like, just give us the money, don't ask questions. And it apparently produces amazing results, because when marketers ask questions, results go down. That's just generally one of the rules of thumb, I guess.
I think it's the most, it's the most fascinating part of Google to me and my sort of like niche interests right now. The fact that they've revived ad.com with, the entire Google platform. It must be fun to be the GM of that.
Yeah, it's also interesting that you've got, in the old days, you had cookie stuffing where, like you said, if you cookied the user at the exact right time, you'd be able to claim attribution credit, and that informed a lot of these algorithms. And it's not great, because that didn't necessarily cause real...
Oh, no, it was arguably fraud.
So I guess I wonder if Google's no longer using cookies and last view for attribution, they're using AI for attribution. I wonder if the AI that places the ads in different places is unwittingly gaming the AI that does the attribution. And I bet no one would ever be able to tell either.
Maybe the AI could tell, and it's not telling.
Well, how do you know? Would you be able to trust the AI? If you have the AI, if it caused an attribution, it would probably...
Isn't that a modern Turing test?
This is the Spider-Man beam of Spider-Man pointing at Spider-Man.
Yeah,
AI.
Yeah, it's a sentient ChatGPT that's basically a media planner. On that note, I think we're going to call it. So, Brian, thank you. This is a great conversation.
Thank you, Brian.
Thanks for having me.
Thank you for subscribing to Marketecture. New interviews are added every week at marketecture.tv and your favorite podcasting app.